What most investors call volatility is often just noise. This is different. What's unfolding now is a structural shift that changes how risk moves through the Western financial system, and it reaches you long before it shows up in headlines. Your retirement account, your mortgage rate, your job security, and the price of the basics you rely on are all tied to the same hidden plumbing cross-border capital: flows reserve, allocation, and supply chain choke points. When that plumbing starts to reroute markets, don't announce it. They misprice it quietly until the repricing arrives all at once. In the past 2 years, a scale of repositioning has been discussed in public as if it were routine portfolio management. But the difference between normal rebalancing and systemic repositioning is intent and sequence. Normal rebalancing spreads risk. Systemic repositioning concentrates it by moving away from the assets that anchor the old order and into the instruments that still function when trust breaks. You do not need a conspiracy to produce that outcome. You only need large actors responding to incentives, constraints, and timing. This isn't coincidence. It is what happens when leverage is accumulated in one direction for years, and then the owner of that leverage begins to convert it into optionality. The moment that conversion starts, it changes the behavior of every connected market, even if prices stay calm on the surface. Liquidity becomes more fragile, funding becomes more sensitive. Small shocks produce outsized moves because the buffer that once absorbed stress is being quietly removed. This pattern has appeared before, and it always begins the same way, not with collapse, but with a period where the visible world looks stable, while the settlement layer is being rearranged underneath. The public focuses on daily price action. The system responds to inventory's collateral payment rails and the confidence that counterparties will still show up tomorrow. When those foundations are being rebalanced across borders, the first signal is rarely a crash. The first signal is a slow change in what is considered safe, what is considered liquid, and what is considered untouchable. Once the stage begins, the question that matters is no longer whether markets are overvalued or whether a recession is coming. The question becomes whether the architecture that allowed the last 30 years of Western financial dominance to operate smoothly is still being fed by the same assumptions. Because if those assumptions are being withdrawn incrementally, methodically, then the eventual stress is not a surprise event. It is the delayed effect of a process that was already set in motion. For decades, the dominant belief has been simple and comforting. Deep economic integration makes conflict irrational. If two powers trade, heavily share supply chains, and depend on each other's markets, then disruption would hurt both sides too much to ever be chosen. This idea became the moral foundation of globalization and the intellectual excuse for outsourcing financial interdependence and the concentration of production far from end consumers. It sounded logical, it felt modern, and it was dangerously incomplete. The flaw sits in a single assumption that rarely gets examined. Interdependence is treated as symmetrical by default, as if exposure on both sides carries the same weight. In reality, economic systems do not reward symmetry, they reward control. When one side depends on continuous access, while the other controls timing, settlement or substitution dependency stops being mutual and becomes directional. At that point, integration no longer prevents pressure, it creates it. This isn't coincidence. It is the predictable outcome of confusing volume with power. High trade flows do not mean balanced leverage. Large financial linkages do not mean shared vulnerability. What matters is not how much moves between systems, but which side can endure interruption longer, which side can reroute faster, and which side can absorb short-term pain without destabilizing its internal structure. The side with deeper buffers, alternative channels, and centralized coordination gains an option the other side does not have. This pattern has appeared before whenever an established system assumes permanence and a rising system uses time to prepare. Economists often describe integration as a peace mechanism because they focus on aggregate welfare. Power operates at the margin. It shows up when stress is introduced and choices must be made under constraint. At that moment, the question is not who benefits in normal times, but who sets the terms when normal times end. Once this stage begins, cooperation does not disappear. It becomes performative. Agreements continue to be signed, markets continue to trade. Public language remains calm and technical, but underneath incentives shift. Decisions are no longer optimized for growth inside a shared system, but for survivability outside of it. And that is the moment when interdependence quietly transforms from a stabilizer into a weapon without requiring hostility, declarations, or open confrontation. To understand what is happening, you have to stop looking at events as isolated decisions and start looking at them as phases of a machine. Systems do not collapse randomly. They move through recognizable stages, driven by incentives, constraints, and the accumulation of imbalance. When those stages align, outcomes stop being a matter of opinion and become a matter of sequence. The first stage is always integration. Two economic powers become deeply connected through trade capital flows and shared production. Supply chains stretch across borders. Financial markets intertwine. Each side grows wealthier by specializing in what the other needs. Politicians describe the relationship as mutually beneficial. Analysts point to efficiency gains. Risk appears reduced because exposure is shared. At this stage, dependence is framed as stability, and the system feels stronger precisely because it is more connected. The second stage begins quietly, often unnoticed. Accumulation becomes asymmetric. One side consistently runs surpluses, while the other runs deficits. One side builds reserves, industrial depth, and strategic inventories. The other builds debt, consumption-driven growth, and confidence that access will always remain open. On paper, both sides are still benefiting. In structure, power is already shifting. Leverage is being stored, not spent. This pattern has appeared before, and it never announces itself. The dominant system interprets the imbalance as temporary or self-correcting. The rising system treats it as preparation. What looks like patience from the outside is actually positioning. What looks like efficiency is often concentration. Over time, the system becomes optimized for continuity, not resilience. The third stage is repositioning. This is where the shift becomes irreversible. The side that accumulated leverage begins to diversify away from single points of failure, while maintaining the appearance of cooperation. Alternatives are built in parallel: new suppliers, new settlement paths, new reserves, new trade routes. Nothing dramatic happens on the surface. Markets remain functional. Headlines remain technical. But dependence is no longer symmetrical. One side is preparing to operate with less exposure. The other is still assuming full access. Once this stage begins, the system enters a zone where outcomes are constrained. Choices narrow, responses slow. The final stage does not require aggression or surprise. It only requires timing. When leverage has been fully converted into optionality, disruption becomes a tool rather than a risk. At that point, collapse is not an accident. It is the delayed result of a structure that was built to function smoothly, not to withstand separation. To see why this sequence produces the same outcomes again and again, you have to look beneath markets and politics and focus on the mechanisms that actually transmit stress. Financial systems do not fail because confidence suddenly vanishes. Confidence vanishes because specific channels stop functioning the way participants assumed they always would. Those channels are funding settlement and substitution, and all three are governed by structure rather than sentiment. Modern markets are built on continuous refinancing. Governments roll debt. Banks roll liabilities. Corporations roll short-term funding. This works as long as liquidity is abundant and counterparties believe they can exit positions without friction. The moment a major holder of financial claims begins to step back, even gradually, the cost of capital starts to rise. Not explosively at first, but persistently. Higher yields are not a signal of panic. They are a signal that someone who used to absorb risk no longer wants to. This isn't coincidence. It is the mechanical result of balance sheets adjusting under constraint. When large pools of capital reduce exposure to a specific asset class, central banks are forced into a choice. They can allow rates to rise and risk contraction, or they can intervene and expand their own balance sheets to stabilize prices. Both options carry consequences. One slows the real economy, the other weakens the currency and erodes trust over time. The system appears stable until the trade-offs accumulate. Supply chains operate under the same logic. Efficiency favors concentration. Resilience requires redundancy. For decades, production was optimized for cost, not interruption. That means substitution is slow by design. When access becomes conditional rather than guaranteed, delays propagate. Inventories thin, prices rise. The pressure does not need to be total to be effective. Partial restriction, regulatory friction, or timing delays are enough to expose how dependent downstream systems have become. This pattern has appeared before whenever financial leverage and production leverage converge. Payment systems, clearing mechanisms, and reserve assets act as the circulatory system of the global economy. If those pathways are rerouted or duplicated elsewhere, the original system does not collapse immediately. It becomes more brittle. Stress that once dissipated now concentrates. Small disruptions create outsized reactions because buffers have already been drawn down elsewhere. Once this stage begins, policy responses lose their effectiveness. Fiscal tools arrive too slowly. Monetary tools trade one risk for another. Rebuilding capacity takes years, not quarters. None of this requires hostile intent. It follows directly from incentives embedded in the system. When architecture is optimized for continuity under a single set of assumptions, even modest changes to those assumptions can produce nonlinear outcomes. That is how a stable system quietly crosses into a fragile one without a single dramatic trigger. The first modern example of this sequence played out before most people realized finance itself could be a battlefield. At the start of the 20th century, Britain sat at the center of the global system. London was the clearinghouse of world trade. The pound sterling functioned as the primary reserve currency. British banks financed commerce across continents, and British confidence rested on the belief that this position was permanent because it was deeply embedded in global trade. Germany entered that system as a rising industrial power. Manufacturing expanded rapidly. Exports surged. Commercial ties with Britain deepened. On the surface, the relationship looked like a textbook case of mutual benefit. Trade volumes grew, capital moved freely. British elites argued that war between such interconnected economies was irrational. Economic integration was assumed to be a stabilizing force. Beneath that surface, the pattern was already forming. Germany ran sustained surpluses, while Britain increasingly relied on financial dominance rather than industrial depth. German institutions began shifting reserves away from sterling and toward gold. This was not a reaction to crisis, it was preparation. Gold offered independence from British-controlled finance at a time when sterling exposure still seemed safe to most observers. The repositioning was gradual, technical, and largely ignored outside specialist circles. This pattern has appeared before, and the British case shows how easy it is to miss when confidence is high. British policymakers focused on visible indicators, trade volumes, capital inflows, market stability. What they did not focus on was who would control settlement under stress. As Germany reduced reliance on sterling-based finance and strengthened alternative arrangements, the balance of leverage quietly shifted. By the time open conflict began, the financial groundwork was already in place. The shock did not come from military defeat. It came from financial interruption. Gold movements, asset freezes, and disrupted settlement channels triggered severe strain inside Britain's banking system. The assumption that London would always be liquid, always be trusted, always be central proved false the moment the system moved from cooperation to constraint. Once this stage begins, the dominant power's advantage becomes a liability. Britain's global exposure, once a source of strength, amplified stress rather than absorbing it. Emergency measures followed. Convertibility was suspended. External support became necessary. The system survived, but the damage was permanent. Sterling never fully regained its pre-war role. The shift in monetary leadership did not happen overnight, but the trajectory was set. This wasn't coincidence. It was the outcome of asymmetric preparation inside a shared system. Germany did not need to destroy Britain militarily to weaken its financial dominance. The structure had already been altered. When pressure arrived, the system responded exactly as the pattern predicts, revealing how power moves long before it visibly changes hands. The same structure reappeared later in a world that believed it had outgrown such dynamics. After the Second World War, the United States rebuilt Japan and folded it into a US-led economic order. The arrangement looked exemplary. American consumers gained access to inexpensive manufactured goods. Japanese industry gained capital technology and a vast export market. Financial integration deepened. Trade volumes surged. The relationship was widely cited as proof that economic partnership created long-term stability. Yet the imbalance embedded itself quietly. Japan ran persistent trade surpluses while the United States absorbed them through consumption and debt. Dollar reserves accumulated inside Japanese institutions year after year. Those reserves were not inert. They represented optionality. Over time, Japanese capital shifted from passive holdings into strategic assets, real estate, and corporate ownership within the United States. What appeared to Americans as confidence in U.S. markets was structurally a conversion of financial claims into leverage. This pattern has appeared before, and the 1980s revealed its mechanics. When currency arrangements were adjusted and pressure entered the system, the scale and speed of capital movement mattered more than intent. Markets that had assumed continuous demand discovered how exposed they were to coordinated repositioning. The shock did not originate from a lack of growth or technological weakness. It originated from balance sheets that had been optimized for stability under assumptions that no longer held. The outcome was not a total collapse, but it was a warning. Extraordinary intervention was required to prevent systemic failure. Liquidity had to be created faster than stress could propagate. The lesson was not lost on observers elsewhere. Financial power could be exercised without armies, and interdependence did not eliminate vulnerability. It redistributed it. A similar sequence unfolded decades later between Europe and Russia, this time centered on energy rather than manufacturing. Europe treated access to Russian gas as a commercial relationship insulated from geopolitics. Pipelines were built, contracts were signed, industrial capacity was optimized around reliable, inexpensive supply, dependency was framed as efficiency. The system worked smoothly for years, reinforcing the belief that economic ties constrained conflict. Beneath that stability, preparation was taking place. Reserves were accumulated, exposure to Western financial channels was reduced, alternative settlement and payment arrangements were explored. None of this appeared urgent while flows continued uninterrupted. When stress finally arrived, the leverage was already embedded in infrastructure that could not be replaced quickly. Once this stage begins, response options narrow sharply. Europe did not lack wealth or political will. It lacked time. Energy could not be rerouted overnight. Industrial processes could not adapt within months. The disruption did not need to be absolute to be effective. Partial interruption was enough to trigger inflation, suppress output, and force painful adjustments across the continent. This wasn't coincidence. In both cases, the decisive factor was not aggression, but preparation. The side that had optimized for survivability outside the shared system endured. The side that had optimized for efficiency within it absorbed the shock. Different eras, different assets, different political contexts, but the same underlying sequence. When asymmetric accumulation is followed by quiet repositioning, the eventual stress reveals where power had already moved long before it was acknowledged. When this framework is applied to the present, the sequence becomes difficult to ignore. Over the past 3 decades, China moved through the integration phase at an unprecedented scale. Manufacturing migrated, supply chains lengthened, capital and technology flowed in both directions. The global system adjusted around the assumption that this arrangement would deepen indefinitely. Efficiency improved. Costs fell. Exposure widened. What looked like mutual dependence became the foundation of a single highly optimized structure. The accumulation phase followed naturally. Persistent trade surpluses translated into vast reserves. Industrial capacity expanded across critical sectors at the same time downstream economies shifted toward consumption services and financialization. This divergence did not signal weakness on either side in normal conditions. It created asymmetry under stress. One side accumulated buffers and optionality. The other accumulated reliance on continuous access. This pattern has appeared before, and the current repositioning phase bears the same signatures. It does not arrive with declarations or sudden breaks. It arrives through diversification. Exposure to single points of failure is reduced. Alternative routes for trade settlement and financing are developed in parallel. Redundancy is built quietly while existing channels remain open. From the outside, activity looks incremental and technical. From the inside, the system is being prepared to function under different assumptions. What matters here is not any single policy move or headline event. It is the direction of travel. When reserve composition changes, when settlement options multiply, when supply chains are designed to operate with fewer choke points, controlled elsewhere, the system is being conditioned for separation. This does not mean disengagement happens immediately. It means dependence is being converted into choice. The ability to endure interruption becomes more important than maximizing efficiency during stability. Once this stage begins, behavior across markets shifts even if prices do not. Long-term contracts are reassessed. Inventories are treated differently. Capital allocation becomes more conservative in exposed areas and more strategic in protected ones. These adjustments are not reactions to crisis. They are pre-crisis adaptations. The system is still functioning, but it is no longer being reinforced in the same way. This isn't coincidence. It is how large systems reduce vulnerability without triggering disruption prematurely. The surface remains calm because maintaining continuity is still beneficial. Beneath it, assumptions are being revised. The question is no longer whether integration created prosperity. It clearly did. The question is whether that prosperity depended on conditions that are now being quietly withdrawn. Once this stage begins, reversibility fades. Rebuilding lost capacity, rerouting production, or replacing settlement infrastructure takes years. Decisions made today reflect expectations about constraints tomorrow. The actors adjusting earliest gain flexibility. Those assuming continuity retain exposure. At this point in the sequence, the outcome is not determined by intent or rhetoric. It is determined by how far preparation has progressed relative to dependency. The imbalance does not announce itself. It reveals itself only when stress tests the system that was built to assume it would never arrive. At this point in the sequence, the discussion shifts from probability to constraint. The system no longer behaves as if every path remains open because structurally they do not. What looks like choice on the surface is increasingly shaped by commitments made years earlier, debt levels that cannot be reduced quickly, supply chains that cannot be rebuilt on command, and monetary arrangements that rely on confidence that is difficult to restore once questioned. These are not policy errors. They are the natural byproducts of an order that optimized for scale and efficiency over resilience. This isn't coincidence. It is the inevitable tension that emerges when a mature system carries obligations that grow faster than its flexibility. High debt narrows policy space. Financial markets become sensitive to even modest changes in funding conditions. Each intervention designed to stabilize the system introduces secondary effects that must be managed later. Over time, responses become reactive rather than preventive. The system remains operational but increasingly fragile. This pattern has appeared before whenever monetary dominance begins to erode. Reserve currencies do not lose relevance in dramatic collapses. They lose it through gradual substitution. Trust does not vanish overnight. It thins. Each new workaround, each alternative channel, each bilateral arrangement that bypasses the old core slightly reduces the system's centrality. None of these moves are decisive in isolation. Together, they change the baseline. Once this stage begins, time becomes the critical variable. Capacity cannot be rebuilt at the pace of financial stress. Industrial ecosystems take years to mature. Resource processing cannot be scaled instantly. Monetary credibility, once questioned, requires sustained discipline to reestablish. These realities impose asymmetry. One side enters the transition having prepared for constraint. The other enters still optimized for continuity. The result is not immediate collapse, but inevitability in direction. Volatility increases. Policy effectiveness diminishes. Shocks that would once have been absorbed now propagate. The system starts to behave less like a shock absorber and more like an amplifier. Stability becomes conditional, dependent on constant intervention and favorable timing. That is not resilience. It is exposure managed day by day. At this stage, outcomes are no longer determined by debate about intentions or by confidence in institutions. They are determined by arithmetic. Debt service costs rise as buffers thin. Replacement costs exceed legacy assumptions. Trade-offs that were once theoretical become binding. The order that defined the previous era can continue to function, but only with increasing friction and decreasing margin for error. Once this stage begins, reversal is no longer a matter of decision. It is a matter of reconstruction. And reconstruction, by definition, unfolds more slowly than disruption. That asymmetry is what gives this phase its weight. The system has not failed, but it has crossed into a condition where failure, if triggered, would no longer be containable in the way it once was. At the end of this sequence, the most important distinction is not between optimism and pessimism, but between positioning and assumption. Systems do not reward those who predict collapse early. They reward those who reduce fragility before stress becomes visible. By the time disruption is obvious to everyone, flexibility has already been lost. What remains are forced choices rather than strategic ones. This isn't coincidence. It is how every large transition reallocates outcomes. The actors who recognized structural change while conditions still looked stable were able to adapt gradually. They did not need perfect forecasts. They needed alignment with incentives that were already shifting beneath the surface. Those who assumed continuity because it had lasted for decades discovered too late that continuity was the variable that had changed. Once this stage begins, preparation matters more than conviction. Reducing exposure is not an act of panic. It is an acknowledgement of asymmetry. Systems built for efficiency under a single dominant framework behave poorly when that framework weakens. Assets tied tightly to uninterrupted flows, cheap funding, and stable settlement perform well until they do not. Assets designed to function under friction scarcity or repricing preserve optionality when others lose it. This pattern has appeared before, and the lesson is consistent. The goal is not to abandon the existing system overnight. It is to avoid being fully captive to it. Diversification, redundancy, and liquidity are not defensive postures in transitional periods. They are sources of leverage. The ability to wait to move or to endure becomes more valuable than the ability to maximize returns under ideal conditions. Once this stage begins, inaction is itself a decision. Exposure compounds quietly while attention remains fixed on short-term signals. The system continues to operate, reinforcing the illusion that nothing fundamental has changed. But structure always asserts itself eventually. When it does, outcomes are swift because the groundwork was laid long before the trigger. What comes next is not a single event, but a sequence of pressures that test which parts of the system were built for continuity and which were built for transition. Understanding that distinction is the first step. In the next stage of this analysis, the focus shifts from structure to impact, where stress concentrates first, which areas absorb it, and how the transition expresses itself across markets and regions. The sequence does not accelerate because people notice it. It accelerates because it is already in motion.